It's Friday, and you know what that means. Friday with a friend. Stay right there. I'll be right back.
Talking about money, right?
Separate yourself widely from the pack moving forward. That's something that you would be willing to have a discussion about.
Because they didn't get it.
They
were
probably
like,
didn't
right.
get it. Yeah.
To follow up with your clients, to generate more leads. You know what I mean?
Always check to make sure.
Hey everybody, happy Friday. This is Millennial Market Talk, and this is your daily Millennial Mortgage update. I'm Mark Jones, branch manager of Directions Home Loan at Cantera in San Antonio, host of Key Factors podcast, and co-founder of ReviewMyMortgage.com, the largest index of mortgage programs nationally. And today is Friday with a friend, so I'm not going to waste any time. Let's jump straight into our daily interest rates. All right, and disclaimer, as I always have to read when we start these, is the following. These mortgage rates are estimated by a third party using industry averages for owner-occupied properties and do not include refinance options. Rates may vary based on the availability and lender approval. That being said, let's jump and quote our first rate. We're going to continue to use $300,000 as the loan amount, which is the average purchase price in Texas. Let's go actually to 5% down, and we will take the credit score to above 740, between 740 and 759. And as of today, our 30-year fixed mortgage is going to be 4.03%. But let's also, as usual, move this back down to a 676, which is the average credit score for Texas. And that would yield you an interest rate of 4.59% on a 30-year mortgage. Putting 20% down just for giggles would actually yield you a higher rate, 4.723. Funny that we show that on screen because as we jump into our article for the day, the article is entitled "1/3 of Millennial Home Buyers Plan on Making Less Than 20% Down Payment." Here's why that's a mistake. And this article is written by Maury Backman. This article starts with, "Coming up with a down payment for a home is no easy feat. This especially applies if you're a younger buyer and haven't been in the workforce long, thereby narrowing your savings window. Some conventional mortgage lenders will allow you to purchase a home with 5% down. Others may require 10 or more, but it's a good idea to bring 20% down to put at the table and when you buy a home. Yet a new survey by Real Estate Witch, 1/3 of millennials who are looking to buy a home said that they plan on putting less than 20% down at closing. That's a mistake they might regret." And this is what Maury says. Let's continue. "Why a lower down payment could hurt you. These days, some values are up across the board. Coming up with 20% of a home's purchase price is tougher to ask than ever. In spite of that, it really pays to bring 20% to the table. If you don't, your mortgage could cost you a lot more. If you take out a conventional mortgage and don't make a 20% down payment, you'll be stuck paying private mortgage insurance or PMI. But don't let the word insurance fool you. PMI isn't meant to offer you any protection. Rather, it's meant to protect your lender in the event that you default on your mortgage payments. PMI can equal up to 1% of the amount you're borrowing and in your mortgage and commonly paid on a monthly basis. This means that you're taking out a $300,000 mortgage, you might get stuck paying $3,000 in PMI every year. That's an extra $250 a month that'll be tacked on to the existing mortgage payment. And it's money you'd probably rather keep to yourself." And the article continues. It says, "Consider holding off on buying a home. If you don't have enough money socked away to comfortably make 20% down payment on a home, then you may want to hold off on buying. One more thing, you don't want to get stuck with PMI. But also, if you don't bring 20% to the closing, you might end up in a scenario where you're underwater on your mortgage if property values fall. When you're underwater on your mortgage, it means that your home is worth less than the mortgage balance. It's not a great situation to be in because if the need to sell arises, such as a loss of a job or need to relocate for work, you're out of luck. Even if PMI didn't exist, it's still a good idea to start off homeownership with 20% equity." While it's easy to see why millennial buyers might struggle to come up with 20% down in today's housing market, it's a better idea to hit the 20% target before moving forward with a home purchase. If you're not there, there's no shame in that, but it definitely pays to consider waiting. All right. So, Maury, I've got a couple of things to say, but I want to bring on our guest for today, which is Javier Villarreal. Javier, how's it going?
Doing pretty good, Mark. Thanks for having me.
Awesome. So, you were the loan officer that brought this to me, and I want to hear your thoughts on it. What's going on in this article?
So I think one of the biggest points that this fails to add is that, it asserts that a 20% down payment is the best option for every buyer, and that's certainly not the case. I believe that the buyer who has an excess amount of cash reserves after putting down a 20% is someone who can afford to do this. But a buyer who would be reaching into their emergency funds and then being left with nothing after putting down a 20% down payment, that's just not feasible. This article also asserts that if you don't have 20% down ready, you should wait. And for a modest home around $250K, that's $50,000. A lot of people aren't able to amass that quickly enough, and especially in today's market when you're waiting, considering increasing purchase prices and increasing interest rates, your money is buying you less as time goes on. So waiting isn't always going to be a smart decision either.
Those are some great points. I want to spotlight two things that were mentioned with them. Number one, not being a mortgage professional, and essentially they may be a financial guru and continuously be researching things that are best for you in regards to saving the most amount of interest possible. But I think, as you mentioned, there are not fully taken into consideration time, inflation, growth, equity potential, things of that nature. But one thing that I wanted to bring up is 20% down required for the demise of PMI, and that's total BS. That's a myth. Us here at Cantera Loans, Directions Home Loan at Cantera, that we can offer customers any type of conventional loan without mortgage insurance, and there's a couple of ways that we go about that. We either raise the interest rate just a bit so we can help them, they pay it up front, or they can do it monthly as it mentioned here. But another option that buyers have is adding a second lien to the property, which allows them to throw more towards that principal versus the actual mortgage insurance. In addition, allowing them to keep the money in the bank to leverage, to potentially keep for reserves, anything like that. Now, this article does continue to mention that we are in this inflated market to where the bottom is going to fall out and you got to be in a safe place in order for that to happen. So they're basically banking on, even if you put 20% down, you still could lose some of that money too. So if that is the case, why even buy a home, right? And we all know that that's hogwash. If you are in the process of considering renting versus buying, right now, especially with rental prices going up through the roof, I think it's at like 19% increase year over year, you're now getting yourself locked into a lease of paying someone else's mortgage. I would much rather see you pay a tiny bit to mortgage insurance if you don't go with any of the options on the table to remove mortgage insurance up front, than paying your landlord's bills for the next 2 years, year. That also being said, once you get into the market again, let's say it takes you 4 years, 5 years to save up enough for 20% down. And as you mentioned, if you're looking at average home price, $300,000, that's 60 grand. Who knows how long it takes you to do that? But by the time you do, home prices have already increased. And even if we go without the unicorn last 2 years of over 20% increase in home values, the typical here in Texas is around 7% in increase year over year. Now, I will leave you with this final thought, which is you're leaving that money on the table. Bottom line, I would much rather see you invest in yourself with the potential of having that equity, because you've got to live somewhere, in my opinion. We're talking about pennies on the dollar. I also think that they may be considering this your forever home purchase. And that's just not the case these days
Correct.
with our millennial buyers, especially when they're addressing the millennial buyers directly. So do you have anything to add to that?
I mean, I think in general, it is a smart choice to do a 20% down payment when you can afford to do so. Otherwise, as you had mentioned, it's smarter to leverage a smaller down payment and keeping your cash reserves so that way you're not left vulnerable, or leveraging that into other investments, for sure.
And lastly, I want to say opportunity cost. I mean, if we look up the definition of opportunity cost,
and I'll chop all this stuff out. So opportunity cost, the loss of potential gain from other alternatives
opportunity cost, the loss of potential gain from other alternatives when one alternative is chosen. So essentially, you are potentially giving up future opportunities that you would have had without utilizing this entire nest egg that you just saved up. And as we know, it's going to take you a little time to get that 20%, and now it's gone. In my opinion, do you also wait until you get some reserves in addition to this 20% down? Because even if you've got 20% down in the property, if you stop making your payments or aren't able to make your payments, you're stuck too. They're going to take that equity and the property before you can sell it. And if we're in a down market, you're going to lose quickly, which that's when short sales and all those other things come into play. So I don't really mean to chop up this article so much, but I think in cases where this is being displayed to plenty of people searching on Google for 20% down, what should I do when purchasing a home, they're getting this advice from a financial article columnist.
Yeah, and it's kind of discouraging. It's discouraging to buyers, and this demographic it's a big demographic, which you don't want to do, especially in this market. You want to help everyone and encourage those to their road to home ownership much sooner, for sure.
Absolutely. So in closing, guys, I want to say thank you for joining me today, Javier. That was great feedback. And
Thank you.
finally, I want to say that if you're out there reading articles like these, the best thing that you can do is get in contact with a mortgage professional so that they can provide you with the options. If you are in Texas, give us a shot, lockandterraloans.com, and one of our trusted loan officers will be able to provide you your options, give you all of the alternatives, including purchasing and using a conventional loan without putting 20% down that does not have private mortgage insurance on it. That product does exist. Plenty of people take advantage of it to this day, and we will continue to do so and continue to provide our customers with all of their options. There is no one size fit all in this industry, and if you are working with a lender that says here is your only option, get a second opinion. Again, second opinions can be done by visiting lockandterraloans.com. I'm Mark Jones, your millennial mortgage expert, and you guys have a great rest of the day.
You were talking about money, right?
Separate yourself widely from the pack moving forward. That's something that you would be willing to have a discussion about.
Because they didn't get it.
They
were
probably
like,
didn't
right.
get it. Yeah.
To follow up with your clients, to generate more leads. You know what I mean?